Hey, welcome back to Miller Momentum. Man, this has been a long time coming. My deep dive into Vanguard's VFMO and how it stacks up against the momentum funds on offer from iShares and Invesco. Way back in my last video on this topic, and you should go watch it if you haven't, like right now. Go watch it. iShares was my personal preference. Everything in that video still stands except for what I consider the best momentum methodology. Now, don't get me wrong, IWMO would be amazing, and please, iShares, please release that. And MTUM is amazing.
But wait! The unbeatable VFMO is taking over. Neither beast nor machine can stand against it. The giant moth monster stands supreme.
Or flies supreme. Couldn't quite coax the clanker into getting the script exactly right. But why am I fangirling over VFMO now? Why is it being used, for example, in my Azimuth portfolio, which you can check out anytime on my channel page? Well, I'll tell you. But first, a quick disclaimer. I am not a financial advisor, and this is not financial advice. The content in this video is for entertainment and educational purposes only. Past performance is not indicative of future results. Statements made are my opinions. Investing involves risk. Always do your own research. All right, to understand why I love VFMO, we're going to look at 8, maybe more, momentum ETFs side by side. And by the end, you'll know exactly why I like VFMO the best. But first, if you're new to this channel, let's review what momentum actually is. It's the simplest idea in factor investing and kind of the mirror image of value investing. Momentum is the observation that stocks that went up recently tend to keep going up for a while. That's it. It's one of the most documented patterns in finance. And here's what a lot of people get confused about: momentum isn't growth. You see, growth looks at the company, earnings, revenue, and margins. Momentum looks only at the price of the stock. That's it. A momentum fund will happily own a company losing money if the chart is going up, and it'll dump a fantastic business whose stock went sideways. It doesn't care what the company does. It only cares what the stock did. One thing though, almost every fund here that we're going to cover skips the most recent month when it measures momentum. Now, why is this? Very short term moves tend to snap back, so skipping the most recent month keeps you from buying the top of a spike. And there's going to be a surprise at the end. I've gotten requests to cover two funds that are not in the Invesco or the iShares or Vanguard lineup, but you're just going to have to wait until it's time to find out what they are. So, as my catchphrase has it, let's get rolling. Before we talk about a single fund, though, we need to talk about three choices that each of these funds make. The first is universe. What pool is it allowed to fish in? The S&P 500, all US stocks, developed markets outside the US, emerging markets? Second choice is signal. How does it actually measure momentum? How far back does it look? And does it adjust for how wild the ride was getting there? And third is weighting. So once you've picked the winners, how much of each winner do you buy? Do you buy at market cap? Do you use a momentum score? A blend? And critically, is there a ceiling on any one position, or could you load up on 80% NVIDIA? Not recommended, but could you do it? So think of it like grocery shopping, right? Universe is which store you walk into. Signal is how you decide what goes in the cart. And weighting is how much of each thing you buy. And every difference between the funds that we're going to cover, and there are some pretty big differences, comes back to one of these three choices. So, when I tell you later that two funds chasing identical logic own completely different stocks, this is part of why. Universe, signal, and weighting. So let's look at all the funds in Vanguard, iShares, and Invesco. Um, Leaving out the two mystery funds, of course. You'll just have to wait and see again what those are. So fees run from 13 basis points to 39. Holdings run from about 80 stocks to about 673. That's an eightfold spread in diversification for funds supposedly doing a similar job, but on different universes. So look at the VFMO row. The universe is all cap and it has no index. Every other fund on this table tracks a published index. VFMO doesn't. And that's part of why I own it. So, little known fact, Vanguard has one of the best quant teams in the business, and it has an intimate and interconnected history with Avantis as well as Dimensional, which are shops that are very well known for their factor investing approach. Lots of people don't know this because Vanguard is most famous for passive index investing, but that's not all that it does. And, well, Jack Bogle himself owned a lot of shares in active funds, including the Vanguard Wellington. And that's the shop that does their factor investing. It's not discretionary stock picking, it's quantitative rules based approach. And it's often called a non traditional index fund. So, these, like I said, are the 8 funds that we're going to cover, and there's going to be 2 at the end that are a surprise. So hang on. But first, let's talk about VFMO, and I will fully disclose I have an obvious bias here, and I own it as part of my azimuth portfolio. It launched in February of 2018, and it's run by Antonio Pica. That's Vanguard's factor guy right now. And it is the only fund that goes all the way down the cap scale, large, mid, and small, and it pretty much equally weights all of them. All of the other funds stop at mid cap, except for XSMO, of course. And VFMO also has a very, very reasonable expense ratio at 0.13. That's the expense ratio of SPMO. The expense ratio of XMMO and XSMO is considerably higher, but VFMO is kind of like a cool combo of SPMO, XMMO, and XSMO in one fund at a cheaper cost. So that I like. Um, Also, the weighting for VFMO, and this is what really sold me on it. So it's got 673 holdings right now, and the largest position is about 1.2%. And nothing here dominates. It's harvesting momentum uniformly across different cap sizes. And it doesn't have an index, and that's a feature, not a bug. It's what a lot of people call a non traditional index fund because it does operate according to a rules based scheme, but it can trade on days when the other indices aren't, and it can avoid the cost drag that's involved with trading on the same day that everybody else is. Now, the model isn't published. You are trusting Vanguard's process. If you need a rule book that you can audit line by line, VFMO is probably not your fund, but if you understand the academic implementation of momentum, then you may like it because that's exactly what it's doing. Also, uh, about 2.5% of it does sit in foreign listed names, which I'm fine with, and a little over 1% can sit in cash. So it's not a totally pure, clean US sleeve, but again, I'm fine with that. And just look at VFMO in comparison with the Invesco Momentum Suite for the United States. I'm going to skip all of the nitty gritty stuff here and get right down to what I think matters most, which is the sector spread. So you can see that VFMO is much, 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 much more diversified. And then when it comes to market cap, you could see just this really beautiful spread where it's got, about 5% in giant companies and just around 22 to 23% in all of the other cap sizes, including micro cap sizes. And momentum is historically the strongest in small and micro caps. So with VFMO, you're paying only 0.13 expense ratio to get access to these momentum hothouses down here. It now with the weighting of SPMO, XMMO, and XSMO relative to cap size, we can actually construct a US ladder from the Invesco momentum suite to compare against VFMO to give you an idea of how a non traditional quantitative rules based index compares to traditional passive indices like in the Invesco suite. So we can only go back 10 years for this back test because, as I'll mention again and again throughout this presentation, Invesco loves to tinker with its indices. But 10 years is not that bad. So we've got VFMO, and of course, we're going to have 100% of that. And to create the Invesco VFMO proxy, we'll take 20% SPMO, 40% XMMO, and 40% XSMO. And that approximates the cap weighting of VFMO across market cap size. So run the back test, and you can see that the Vanguard US momentum factor, because of that non traditional index ability, because it's able to trade when other indices are not, it slightly edges out the Invesco combination of the Invesco US ladder funds over this period, just barely. But over a long period of time, that just barely matters. And a lot of people pass up VFMO because SPMO has been doing exceptionally well lately. However, as I've said, momentum historically is the strongest in smaller cap stocks. So over time, yeah, this Invesco VFMO proxy is probably going to be fairly comparable to VFMO, but VFMO, according to the academic literature, will eventually probably smoke SPMO. Just leave it in the dust. Now, about those foreign listed names, that will occasionally happen in domestic stock indices, and occasionally you'll see domestic US listed names in international indices and funds. This happens because, well, sometimes companies move where they're based, and they do that before the index can readjust. And for VFMO, if a company's health looks great, then it's just going to hold on to that company. It's not going to force sell if everything else is looking fine just because they decided to, whatever, move shop to the Netherlands or something. MTUM, on the other hand, although you will occasionally see a foreign stock in it, at its next rebalancing, it's going to toss that out because it is a pure index fund and it is following MSCI USA Momentum as its index. It costs about 15 basis points for an expense ratio. It launched back in April of 2013 and it's the biggest momentum ETF in America. I think somewhere around $20 billion, depending on the day right now. And the signal here, how it handles it, is really smarter than raw price. And I really love its methodology because what it does is it takes the return and it divides it by how volatile the stock's been over a 3 year span. So, in plain English, that means that a stock that walked up a staircase scores better than a stock that took the same trip on a roller coaster. So, steady winners over violent ones. I really like that a lot because slow and steady, hey, it's more likely to win the race. Goes back to the tortoise and the hare, doesn't it? Now, the one thing that I kind of hesitate about MTUM is that it holds about 125 stocks, so that's good, but it's all concentrated up at the top end of the spectrum. So the top 10 holdings are roughly about 43% of the fund right now as of this recording. Of course, this is a momentum fund. Concentration can be a feature, not a bug, and it's always going to change, right? Right now, the sector mix is also pretty interesting. So early in 2026, it was 39% technology and 16% industrials. Um, so now it's kind of switching a little bit, probably because of different factors involved in the tech sector right now and concerns over the AI bubble and the data center buildouts. And momentum is built to ride those trends. So it's not a problem when you see momentum ETFs and funds becoming concentrated or focusing on single sectors. That's what they're supposed to do. I mean, that's the whole point of the strategy. You chase winners regardless. Unless, of course, you're VFMO, and then you chase winners in each sector in a more balanced way, which I personally think is going to be the winning strategy in the end. But credit where it's due. MTUM does cap any single issuer at 5%. And that cap is the only genuine guardrail here. But a 5% position cap, it's not going to save you when the whole top of the portfolio is one sector. But MTUM does have a cool little fail-safe mechanism that it can trigger, which is an ad hoc rebalancing if the market passes a certain threshold of volatility. And it does that as a parachute to try and lessen the blow of a momentum crash. But VFMO's 1.2% top position, compared to MTUM, you can see why these two funds are completely different products and not just two flavors of the same one. Now, that being said, VFMO has tracked very closely MTUM over the past about 8.5 years. You can see that it has edged out MTUM. It's currently in the lead, you could say, if you're into that horse race type language when it comes to investing. Um, and it did better in the just awful, no good year of 2022. So keep in mind, VFMO very likely to beat MTUM over the long run. And not just in absolute returns and risk adjusted, because VFMO goes deeper across cap size, right? But let me show you something really interesting because a lot of people, they're on the SPMO bandwagon, so to speak, right? And so we can add the testful.io now has a US momentum um, asset to just plug in SPMO. So that's nifty. But let's compare MTUM versus SPMO since inception of MTUM. So over the past 10 years, it seems like, hey, SPMO, the red line, it's the obvious choice, right? Well, always, 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 always zoom out and try to have as deep of a back test as possible and look at the most history that you can for a fund. Because here's the thing, if you started investing in SPMO in 1994, which kind of a very similar moment in terms of the market, right? The internet was on the rise. Now AI is on the rise. You can see that MTUM and SPMO are just neck and neck. And then they slowly begin to diverge, sounding familiar. SPMO's in the lead. And then, the dot com bubble pops. And MTUM, because it had that nice little emergency ad hoc rebalance feature, and because it has more names and it dips into mid caps and is a little bit more diversified, well, it didn't have nearly the crash that SPMO had. And then it just continued to perform well. And it took SPMO the better part of 20 years to get back up within hitting distance of MTUM. So, you know, if VFMO has been shown to already be pulling ahead of MTUM, and MTUM has a demonstrated record of pulling ahead of SPMO after a crash, well, you can draw the conclusion. I mean, past performance is not indicative of future results, but it certainly can be some supporting evidence for why they may or may not be likely. Now, IMTM is just MTUM with a passport, so I'm not going to spend too much time on it. It's the exact same methodology, caps, volatility screening, etc., but it's just pointed at developed markets outside the US. So it costs 30 basis points for its expense ratio, so double MTUM, but that's just due to the frictions involved in trading international stocks. And it's got about 337 holdings right now. It's far less concentrated than MTUM at the moment. Top 10 is about 22%, mainly in financials versus MTUM's 43. But again, that really doesn't mean as much for momentum funds as other ETFs and other mutual funds, right? Because the whole point of momentum is to chase what's winning according to whatever scheme you've come up with. So, MTUM, IMTM, they're just chasing winners across the board. So, if financials are winning, that's mainly where they're going to pick names from. If industrials are winning, well, guess what? They're going to become industrial funds. If we have a rotation and value starts coming up, guess what? They turn into value funds. That's the cool thing about momentum. It's adaptable. So, the yield right now is has been about north of 4%, so even more than SCHD. And again, that's because IMTM has currently rotated into the financial sector, and that's kind of a cool thing with momentum funds. They just mutate on you, which I think is great, especially paired with value. Now, Invesco runs five momentum funds, in contrast to iShares with MTUM and IMTM, which allows a more targeted and strategic partitioning across different cap sizes and markets. But they all share one engine, so I only have to cover it once because all the funds use this. The only difference is their universe. The S&P signal is price change over 12 months, and it drops the most recent month, and then it divides by volatility. And it only has one look back window instead of iShares 2. It's simpler and it reacts faster to a change in leadership. And that can have both pros and cons, because it's a little more cautious. That is, iShares is a little more cautious. Invesco is the opposite. They're a little bit more aggressive. They lean harder into regime changes and ride trends harder. And the weighting scheme here is market cap times momentum score. And the cap on any single position, well, practically speaking, it's higher than iShares. It has changed some according to methodology because unfortunately Invesco does tinker with its funds a little bit more. So be careful if you invest in Invesco. Make sure that you're watching your fund and it keeps the methodology that you want because it used to be 7%. Now I think it's capped at around 12%. But again, that's not necessarily a bad thing because it allows the momentum factor to really run wild, doesn't it? And Invesco rebalances twice a year, the third Friday of March and September, and it's documented, not ambiguous, and you know, if you like an open rule book, then Invesco's got you covered. Just be careful because it sometimes updates that rule book. And the practical consequence of having that open rule book published with a twice yearly rebalance on a fixed date is that everyone knows it's coming and traders can position ahead of it. Or if they're really savvy and set up with some really sophisticated platforms, they can go ahead and just buy the stocks and positions at the same time as the fund does as soon as it's disclosed. And the VFMO strategy kind of navigates around that, which is another boon of the way that Vanguard approaches things with momentum and also, value and other factors. And it's also an advantage that funds like Avantis and Dimensional have by taking that non-traditional index fund approach. This is not a knock on Invesco. This is just the way things are. So let's talk a little bit more about Invesco's US ladder. SPMO is the big one here that everybody and their dog and their grandma has made a YouTube video about. At $21 billion and a relatively fair expense ratio of 13 basis points, everybody loves to love this fund. And it's been doing great over the past few years, just knocking it out of the ballpark. A little bit lesser known, a little bit less love would be XMMO, and that's the mid caps, and it's been doing really good too. And it's the most concentrated fund because it only has about 80 stocks in it at any given time, and that's just an accident of its index because the mid cap 400 has, you guessed it, 400 stocks. And the way Invesco does this is they take in each of these indices the top quintile, the top 20% of the stocks that have the highest momentum scores. And so if you've got 400 stocks to choose from and you got to take the top 20%, that gives you 80 stocks. Now, XSMO is small caps. It's the most expensive. It's got 39 basis points for its expense ratio, but that's not unexpected because it is more expensive to trade small cap stocks. Now, the fee ladder, 13, 34, 39, it goes up as market cap size goes down. That's not greed. It's just the physics of trading. If you're going to trade in the small cap universe, there's less people trading, wider spreads, more friction. Now, both XMMO and XSMO technically launched in March 2005, but don't be fooled by that because, as I mentioned before, Invesco likes to fiddle with its indices and its funds over time. And XMMO and XSMO were not momentum funds for a large part of their history. They were, I think it was like an IntelliDex semi-active trading strategy and then a high beta strategy, kind of all over the place. And then Invesco decided, hey, we're going to have a momentum suite now. So we're going to take these two funds and they are now momentum funds and we're going to attach their assets to these two indices. and thus XMMO and XSMO were born. Testful.io has an XMMO sim ticker that simulates the current index that XMMO is based on, and that's the one I use for backtesting. It also has an index for SPMO, which has always followed the same index since its inception, pretty much because it's done very well. And Invesco wisely says, if it ain't broke, don't fix it. But XSMO, there's not an index that you can really back test it before its current live run on its current methodology on, say, testful.io. Not yet. So be careful when you're looking at the deep history of Invesco funds. So now we want to talk about the international branch of the Invesco suite. IDMO covers your developed markets outside the US and oddly outside of South Korea too, which it puts in EEMO. It's 25 basis points, and that just reflects that it's more expensive to trade internationally. And then you've got EEMO, which is your emerging markets and South Korea as well. Now, EEMO has about $14 million in it, not billion, million. And that's partially because it used to be a totally different fund under Invesco. And Invesco decided, hey, we have this momentum suite. We've already got money in this one ticker. Let's just add it to the momentum suite and change the methodology because the existing fund is dying anyway. And maybe we can resurrect it with a better momentum index strategy. So that's exactly what they did. Hopefully it'll gain momentum, but and come back from the dead here. But be careful because EEMO, on top of Invesco's interesting temptation to constantly fiddle with its fund suites, it also doesn't have a lot of gas in the tank. So it could actually get closed. And for a retail investor, maybe that's a risk you want to know about. But then again, maybe the methodology attracts you so much that you're willing to take that risk. And I think that for most people, at least, emerging markets are going to be a small part of your portfolio. So it's not that big of a deal if it crashes and just pays out its native asset value, because that's what happens when a fund closes. It doesn't go to zero. They just say, hey guys, it's been a good game. Here's your money back. So it's not that big of a deal. Now, one really cool thing that you can do with Invesco's Momentum Suite is you can build yourself an Invesco Global Momentum Fund. So I long and pine for the days when IWMO will become available to US investors. Same with VMO from Vanguard. And hey, go over and pester those firms, submit requests, show interest. Uh, Firms really do respond if enough people bug them and say, hey, why aren't you offering this? But, until that day, um, you can build a global momentum fund right now out of Invesco tickers. And it's the only way that you can actually get a dedicated momentum fund for the developing world, EEMO, uh, just so long as it doesn't close, right? But when you backtest a global momentum fund and, just put 40% in SPMO, 15% in XMMO, 5% in XSMO, 30% in IDMO, and 10% in EEMO. And that'll give you the pretty approximate cap weights of the different areas of the market. And then you'd switch them up if it ever changes. But back testing this 10 years, again, we can only go back 10 because Invesco loves to tinker. But you can see right here that the global momentum strategy does a great job of outrunning its base index, which would be essentially VT. And it's got better absolute returns, better risk adjusted returns, Momentum may be the simplest factor out there, but it's also one of the most effective. So it's pretty cool. So now that we've overviewed our main groups of funds, except for the two surprise ones that I'm going to talk about later, we can go ahead and just recap how their signals differ. So, first, the MSCI based funds from iShares. They have two look back windows, each divided by 3 years of volatility. They're slower, steadier, and they prefer the staircase to the roller coaster when it comes to, how a stock got to be at its current high price. Then you've got the S&P based funds, and those are all five Invesco funds. They have one window, 12 months minus the last month, divided by volatility. They're faster, they're more reactive, and they catch a leadership change sooner rather than later when the market shifts. And finally, you've got Vanguard with VFMO. It looks at roughly a year of momentum through a proprietary model, which is actually not that hard to divine most of it if you're familiar with the academic modeling of momentum, kind of like how you can deconstruct Avantis's approach because it's just the Fama French model of things. But VFMO, they do tell you what they're doing. They don't tell you exactly how. The thread through all of these that they have in common, though, is everybody divides by volatility. And that's what separates a momentum fund from just buying whatever moved the most. Nobody in this lineup is chasing raw price, and that's a good thing. They're looking for consistent, sustained winners, and they really don't care about why they're winning, but they just assume that there must be a good reason, so let's pile in. And hey, that's been a very winning strategy for momentum for centuries across a lot of different markets, and it's one of the most empirically verified aspects of academic finance. So it does work, even though people debate exactly how it works. Um, does the number of windows for look back matter? I mean, two windows gives you a calmer, slower portfolio. One window turns over faster. Neither is right. They're just different strokes for different folks, right? It just depends on what you want to do and where you want to row your boat. And these three families, three signals, one kind of idea of chasing momentum. Um, their portfolios don't really overlap much. Um, and it just shows you that there's so many cool ways to implement momentum, and so you can't just go in and pick a momentum fund because you want to invest in momentum. No, you need to think about what you want to do, because if somebody wants to target, say, mid cap momentum, well, XMMO is the way to go. If somebody says, hey, I don't know where momentum's going to be strongest next in the US market, but I want to chase US momentum broadly. I want to capture the academic momentum factor and have the best shot at the best distribution of good outcomes. Then VFMO is going to be the smart tactical choice. But if you want to do some kind of other weighting, then you might, you know, mix and match in the Invesco US ladder. Or if you want to just trade in the cheapest part of the universe, then you could combine MTUM and IMTM for a global momentum approach that is really simple and only needs two funds if you're okay with foregoing emerging markets. So keep all of this in mind when you're choosing. They all also differ in weighting and concentration, like we've talked about. Um, and that can be good for some people, bad for others. VFMO I like because it actually does have a pretty vigorous cap. Other people who want to really ride trends all the way and don't want any backup, value supporting factors or anything like that, Invesco funds have got you covered. because they can lean hard and fast. And MTUM and IMTM is kind of the moderate middle. As to which of these strategies will be most effective, well, it just depends on the macroeconomic conditions you're in, you know? So it's going to vary over time. So when you want to incorporate a momentum factor fund into your portfolio, I think there's four questions you should ask yourself before you commit to anything. The first is, which slice of the market do you actually want to cover? And do you already own it elsewhere? So if you hold a total market index fund and that's part of your strategy, you already own most of these companies. A momentum fund tilts your mix. It doesn't add a new asset class. Unless, like me, you're combining uncorrelated slices of the market and you tend not to go for total index funds. Second, do you want a rule book that you can read? Or are you fine with a model that you can't see, like Vanguard offers? So, for a lot of people, this is the real fork in the road. And I came down on the side of VFMO for similar reasons to why I prefer, Avantis funds to Vanguard's value indices. Now, Vanguard does have a value strategy, but I just like Avantis's active funds better. And they are active in the sense of being non traditional index funds, which means they're still rule based, but they aren't bound to trade on the exact same days and in the exact same ways as indices that, say, S&P owns. So, third question that you need to ask yourself is, can you hold through a sharp reversal? Momentum's weak spot is rotation, not slow markets. So when trends break, momentum's going to suffer or it's going to lag a lot. The way that I answer this question is by holding value and momentum together typically, so that they compensate for when one is down, the other is up. Now, in the azimuth portfolio, I compensate for this by holding momentum and managed futures trend following together, because that's also a really good combination where each covers the weaknesses of the other. And the fourth question that a lot of people tend to skip over is the fund that I'm interested in large enough and liquid enough that trading costs don't eat my returns? If you're a long term investor, spreads and stuff are a little bit less important because you're not going to be buying and selling. And I mean, I think that that's the way to go. Long term investing, not constantly buying and selling. But you do want to make sure that the fund that you're investing in is going to be there in, 10 or 20 years. And with a firm like Vanguard or Avantis, I trust that. With Invesco, I don't know. They like to tinker, so I tend to stay away from them, but that's just me. Surprise! We're going to talk about Fidelity and JPMorgan too, as other momentum kaijus that I haven't covered yet. I know some of you were probably expecting FMTM, but we've already done a video on that, and you can go and watch it. Psych! I am going to talk about FMTM just a little bit, but seriously, go watch the full video on it. So, in a nutshell, I'm not really too impressed by FTM just yet. First of all, it uses a weaker look back window for detecting momentum, 6 months instead of 12 months. And it's just really, really new, and it's really, really concentrated, and it just does equal weight for the stocks that it picks thus far. I'm not really sure that that's the best methodology. I think that a momentum score times cap size is probably better. But anyway, let's take a look at how it stacks up against VFMO, JMOM, FDMO, and well, I've got to add iShares, don't I? It's not complete without iShares. So let's add iShares MTUM, just like that. And then run the back test and see what we get. So again, FMTM, it's only been around 1.4 years, so cool your enthusiasm. But we could see that, yeah, I understand why people are into it. It's been really pulling ahead here lately, but then it just kind of sank back into the rest of the crowd. And look over here. It was actually on the bottom for the first part of its journey. And really, when you look at things, it's actually Vanguard's VFMO, that little blue line in the middle, that impresses me the most because it's a more consistent upward trend. You see, market desk is kind of all over the place, and right now it's neck and neck again with VFMO. So, why wouldn't you go with VFMO, which has far more stocks, sector diversity? It's really just harvesting the actual momentum premium instead of sector relative strength. And when you look at the Sharp ratio, you can see that JPMorgan actually has the highest Sharp ratio out of the bunch, even though it's one of the lower returns. So don't just assume that FMTM is the best momentum fund since sliced bread simply because it's been doing well for a few months. So, first up, FDMO, the Fidelity Momentum Factor. At 15 basis points, it's very reasonably priced, and it was launched in September of 2016. It looks at US large and mid cap, and it's really trying to compete with MTUM. The signal is relative price performance over roughly 6 to 12 months, and it has around 130 holdings, the top 10 at about 38%. And fun fact, Fidelity doesn't even run it day to day. It's sub advised by Geode Capital Management. And there's a little bit of a quirk here because FDMO tracks the Fidelity US Momentum Factor Index. Fidelity built that index and it owns that index. But then Fidelity sells the fund that tracks it. So it's kind of self indexing here. It is completely legal and increasingly common to do this, and it can be genuinely lower cost because you're not paying MSCI or S&P Global a licensing fee. And those tend to be the duopoly right now on passive index investing, which is why you're seeing a lot of these other firms just creating their own indices to avoid having to pay the toll. But you do need to understand that the people writing the rules here also profit from the product, which not necessarily a bad thing if it's an index because they make money if you make money, but you know, you should still know that. And it's not the same thing though as MTUM following a rule book that MSCI wrote for the whole market. One other thing that matters a little bit more than the fee, FDMO's bid ask spread runs at around 17 basis points sometimes. So that's pretty big. Your annual fee is 15. So if you buy and sell a couple of times a year, you're actually paying more in the spread than in the management fee. Maybe that doesn't matter to you because you buy and hold, but something that you need to know. So that is a drawback. It's a solid fund, it's a sensible signal, but this is why in like in other fee focused videos, like when I was comparing DBMF and SDMF for managed future strategies, which are actually identical, I kept hammering home the fact that the headline fee isn't the full price of a fund that you buy. So people who are focused on that headline fee and getting it as low as possible, well, there's other factors involved, and sometimes a fund that has a higher expense ratio can actually be cheaper after you take into consideration those other factors. So just be aware. And then there's also JMOM, JMOM. It's the JPMorgan US Momentum Factor. And at 12 basis points, It's 1 basis point cheaper than VFMO and SPMO, cheaper than anything else that we've looked at in this presentation. So that's pretty cool. It was launched back in 2017, and it's currently at about $1.75 billion in assets. Its universe is the Russell 1000. The signal is 12-month return divided by 12-month volatility. So, kind of similar to the Invesco family. It uses the same risk adjusted logic, though, as MSCI with one window instead of two. So, it's diversified in a way that I genuinely like. Um, and because it uses that same approach as MSCI but with one window rather than two, it's kind of in the middle of Invesco and iShares in terms of its aggressiveness. And right now it's holding about 269 holdings, so about a little more than a third of the holdings of VFMO, and it's cap weighted with sector diversification built in, so no single sector runs off with the whole portfolio. That said, its top positions are still Alphabet, Nvidia, Apple, Broadcom, and Microsoft, which may or may not be a problem for you, but they're sitting at around 2% each, and that's flat. That shape is far closer to VFMO than to MTUM, and as different sectors run, it's going to change because that's the whole name of the game. Now, JPMorgan's own advisor sponsors that index that it's based on and developed the factors it runs on. FTSE administers and calculates it. So the rulebook is published and independently calculated, but authored by the firm selling you the fund, which has an index and has an independent index are two different statements about funds here. VFMO says plainly, we're active, judge our process. JMOM says, here's an index that we wrote. So this is actually kind of the same rules-based quant methodological approach, but in order to appeal to passive index investors, they just do the quant stuff and publish the index from that work and then follow the published index from the active rules as their fund. So it's a little bit of a roundabout way of doing things. And that's kind of the same way that SDMF works with DBMF, where SDMF actually uses DBMF as its literal index. So that's still why I prefer VFMO, because it's a little bit more, I guess you could say, honest about being a non-traditional index fund, being an active quant-based, rules-based fund. But JMOM is very similar, but it also just doesn't have the same broad exposure to different cap sizes that VFMO has, and that's why I prefer VFMO to JMOM. Well, I hope you enjoyed this episode of Miller Momentum. Do come back for more soon, y'all. Next one's going to be about DBMF Revisited and my Atlas portfolio's inclusion of RSST and RSIT, whilst the Azimuth portfolio still uses DBMF. Why the change? And why the retention of DBMF? Well, you'll have to stay tuned to find out why I kept it in one portfolio and pitched it in the other. And then I'm going to dive into commodity funds, including SDCI, HGER, and HARD. And please, no juvenile humor about that last one. Anyway, in the meantime, like, subscribe, share, hype, do all the things. And let me know down in the comments, what's your favorite momentum fund? Did my video change any of your opinions? Do tell. I'll see you in the comments and in the community posts.